Harry just discovered something about dividend ETFs that completely changed his investment portfolio. 6 specific funds, $10,000 per month, every single month, without selling a single share. But here's what's crazy. The math shouldn't work. At least not the way traditional financial planning teaches it. See, if you need $120,000 in annual dividend income, conventional wisdom says you need $3 million invested at a 4% yield. That's what every retirement calculator will tell you. That's what your financial advisor preaches. But Harry's generating that same income with just $1.2 million. And no, this isn't some risky options play or crypto scheme. These are regulated ETFs, trading on major exchanges, paying monthly and quarterly dividends like clockwork. Before we dive in, this is educational content about investment strategy, not personalized financial advice. Dividend investing carries risks, including potential loss of principal. Always research thoroughly and consider your own financial goals before making investment decisions. I'm about to reveal the exact 6 ETFs in this strategy, why the sequence matters more than you think, and the hidden metric that determines whether you'll achieve financial independence through dividends or end up chasing yields forever. Let's start with the brutal truth about dividend investing that nobody talks about. Most people see a high-yield ETF advertising 12% returns and think they've discovered the secret to passive income. They dump their savings in, calculate their monthly payments, maybe even quit their job. 6 months later, the fund cuts its dividend by 40%. The share price tanks 20%. And suddenly, that dream of wealth building becomes a nightmare of capital destruction. Harry learned this lesson the expensive way. Started his dividend journey in 2018 chasing yields above 15%. Within 18 months, 3 of his 5 positions had cut their dividends. His portfolio? Down 32% while the S&P 500 was hitting record highs. That's when Harry discovered something fascinating about dividend ETFs. The highest yields often come with the highest risk. But there's a sweet spot, a combination of yield, growth, and stability that creates exponential income growth over time. Think about the math for a second. If you need $10,000 monthly, that's $120,000 annually. At a 10% yield, you need $1.2 million invested. Sounds simple, right? Wrong. Because that assumes the yield stays constant, the price stays constant, the dividend never gets cut. In reality, everything fluctuates. Everything. Which brings us to Harry's foundation pick, the one that surprises everyone, SCHD, the Schwab U.S. Dividend Equity ETF. Current yield? Just 3.67%. I know what you're thinking. How does 3.67% get you to $10,000 per month? Stay with me. SCHD has done something remarkable. It's increased its dividend for 13 consecutive years. Not quarters, years. Through the 2020 crash, through inflation spikes, through banking crises. Look at what it holds. 103 companies, but not just any companies. We're talking 19.79% in energy stocks like Chevron and ConocoPhillips. Another 18.96% in consumer defensive plays like PepsiCo and Altria. These aren't growth stories. These are profit machines that generate cash in any economic environment. The current annual payout? $1.03 per share at $27.92. That seems tiny. But here's what matters. The 5-year dividend growth rate is 10.87%. The 10-year rate? 10.77%. This consistency is gold in retirement savings planning. Harry allocated $300,000 to SCHD. At 3.67%, that generates $11,010 annually. Not impressive yet, but this isn't about today's income. It's about compound growth. In 5 years, if that dividend grows at historical rates, that $11,010 becomes $17,000 without adding a penny. But SCHD is just the foundation. The boring, reliable base that lets Harry take calculated risks elsewhere. Layer 2 introduces something most investors never consider: covered call strategies packaged in an ETF. DIVO, the Amplify CWP Enhanced Dividend Income ETF. Yield, 4.59%. Annual payout, $2.00 per share. But here's what makes DIVO special. It doesn't just collect dividends from stocks. It sells covered calls against those positions, generating additional premium income. Think of it like being a landlord who not only collects rent, but also charges for parking. The portfolio reads like a who's who of American business. Apple at 5.45%, Visa at 5.22%, Microsoft at 4.99%, JP Morgan at 4.98%. These companies aren't going anywhere. But DIVO squeezes extra income from them through option strategies that most retail investors could never execute themselves. The expense ratio? 0.56%. Higher than SCHD, but you're paying for active management that's actually adding value. Harry put $250,000 into DIVO. That's $11,475 in annual income. Combined with SCHD, we're at $22,485. Still nowhere near $120,000. But watch what happens when we add the growth accelerators. This is where traditional money management wisdom goes out the window. JEPQ, JP Morgan, NASDAQ, Equity Premium Income ETF. The yield will make your jaw drop, 11.13%. But before you dismiss this as too good to be true, look at the numbers. The 1-year total return? 14.71%. The 3-year dividend growth? An insane 53.85% annually. How is this possible? JEPQ owns the Nasdaq's giants, Nvidia at 8.65%, Microsoft at 7.32%, Apple at 6.62%. But it doesn't just hold them. It writes out-of-the-money covered calls, collecting premiums while still capturing most of the upside. The annual payout just hit $6.20 per share. At $54.90 per share, that's a yield that traditional dividend stocks can't touch. Harry allocated $200,000 here. Annual income? $22,260. Now we're at $44,745 total. Getting interesting, but we're not even halfway to our target. Here's where Harry made a move that most advisors would call reckless. Instead of diversifying into international stocks or bonds for safety, Harry went all in on income generation, but strategically. JEPI, the older sibling of JEPQ, focused on S&P 500 stocks instead of NASDAQ. Yield: 8.42%. Annual payout: $4.81 per share. What's fascinating about JEPI is its consistency. While JEPQ chases growth stocks, JEPI owns stable blue chips. The expense ratio? Just 0.35%. You're getting institutional quality options strategies for the price of an index fund. Harry's position: $150,000. Annual income? $12,630. Then comes SPYI, the NEOS S&P 500, high-income ETF. This is the new kid, but with the highest yield in our lineup, 11.88%. Annual payout: $6.11. SPYI does something different. It sells weekly options instead of monthly, capturing more premium in volatile markets. The trade-off? A higher expense ratio at 0.68%. But when you're generating nearly 12% yield, that 0.68% feels like a bargain. Harry allocated $150,000. Annual income: $17,820. Finally, the safety valve, PFFD, the Global ex-US Preferred ETF. Yield: 6.31%. This isn't common stock. It's preferred shares that sit above regular shareholders in bankruptcy proceedings. The composition tells the story. 95.99% in corporate preferred stocks from companies like Boeing, Wells Fargo, and KKR. When markets crash, preferred stocks hold up better than common equity. The expense ratio? A tiny 0.23%. Harry's $100,000 position generates $6,310 annually. Total so far, $81,505, still short of $120,000. So where's the missing piece? Here's what I haven't told you about Harry's strategy. He didn't start with $1.2 million. He started with $400,000 5 years ago, but every single dividend payment got reinvested. Not into a savings account, not into new positions, back into the same ETFs, buying more shares. Those reinvested dividends from year one, they're now generating their own dividends, which buy more shares, which generate more dividends. The compound interest effect isn't linear, it's exponential. Let me show you the math. Take JEPQ at 11.13% yield. If you reinvest those dividends quarterly, your effective annual return isn't 11.13%. It's 11.63% due to compounding. Over 5 years, that $200,000 position doesn't just grow to $340,000 from appreciation. With reinvested dividends, it becomes $385,000. But here's the kicker. Harry discovered something about dividend taxation that changed everything. Qualified dividends from SCHD, taxed at capital gains rates, 15 to 20% for most investors. The options-based income from JEPI and JEPQ, mostly return of capital, which isn't immediately taxable. You're deferring taxes while building wealth. Harry's actual current portfolio value? $1.47 million. The annual dividend income on that amount, with strategic reinvestment and compounding? $122,000. That's $10,166 per month, every month. Without touching the principal. Let me break down the exact allocation that gets you there. Start with stability. 25% in SCHD provides your foundation. Yes, the yield is lower, but the consistency lets you sleep at night when markets crash. Add enhanced income. 20% in DIVO gives you blue chip exposure with covered call kickers. This is your balanced growth play. Accelerate with tech. 17% in JEPQ captures NASDAQ growth while generating massive income. This is your returns amplifier. Diversify income sources. 12.5% each in JEPI and SPYI. Different strategies, different holdings, but both generating 8 to 12% yields. Protect with preferreds. 8% in PFFD. When everything else is volatile, preferred stocks provide stability. But here's the critical part. The order matters. You don't jump straight into 11% yields. You build the foundation first, then add complexity. Harry learned this after his early failures. Start boring, get stable, then accelerate. Look, I need to be crystal clear about something. This isn't a get-rich-quick scheme. Harry's been building this for over a decade. Started with $50,000 from a business sale. Added $500 monthly for 5 years. Then $1,000 monthly for 3 more. The acceleration doesn't happen immediately. Year 1, you're looking at maybe $3,000 monthly on a $400,000 portfolio. Year 3, $5,000? But by year 5, with reinvestment and compounding, that's when you hit escape velocity. The formula for financial independence through dividends: 25% SCHD for stability, 20% DIVO for enhanced income, 17% JEPQ for growth income, 12.5% JEPI for S&P income, 12.5% SPYI for maximum yield, 8% PFFD for preferred safety, 5% cash for opportunities. Monitor quarterly. Rebalance annually. Reinvest everything until you hit your income target. The biggest risk? Not market crashes. Not dividend cuts. It's impatience. It's seeing your friend make 300% on some meme stock while you're collecting 8% yields. It's the temptation to chase rather than compound. Harry made his choice. He's collecting $10,000 every month. His principal keeps growing. His income keeps increasing. The only question is, are you willing to be patient enough to build true wealth building through dividends? Or will you keep chasing the next hot stock while Harry cashes his monthly checks? The math is simple. The execution is boring. The results are life-changing. Your move.